We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. This video is going to be a graphical presentation of Jim Bianco's review of the traditional wealth manager's 60-40 portfolio recommendation to many retiree investors. Now, the traditional 60-40 portfolio recommendation is 60% stocks and 40% bonds. That means when stocks go up, you make money, and if stocks go down, you make money because bonds go down. So in a sense, when stocks go up, interest rates go up as well. You lose a bit of money, but when the stocks go down quite dramatically, interest rates go down. So the relationship you want to see is when stocks go down, the headline interest rate is to go down. That's because money is pouring out of the stock market and pouring into bonds, thus forcing the interest rate down. So to see the 60-40 relationship working in real time over the last 100 years, here we have the Dow Jones log chart, and when the stocks are falling, you want interest rates to fall as well for the 60-40 portfolio to work in periods of great risk and great emotional trauma, let's say. Well, 64 portfolio in the last global financial crisis, stocks went down and interest rates went down, and that is highlighted by the correlation. If the correlation is above 0 or close to 25, that means the 60 portfolio is working. That means your stocks are going down on the portfolio part, but also your bonds are going up. So you're well hedged, you might say. So when the dot-com bubble popped, let's assuming you just had Dow stocks and not Nasdaq stocks, but obviously you might have had a few Nasdaq stocks, but when the stocks fell on the Dow side, interest rates eventually fell. So that, the 60-40 worked well because the correlation between the interest rate and the stocks is high. Now this is the Nixon recession, where Nixon resigned and stocks fell quite dramatically. Here we have a situation where stocks fell, but the interest rates actually went up. So the 60-40 portfolio was a dramatic failure. You lost money in stocks and you lost money in bonds, a complete wipeout. But obviously gold did well. And quite frankly, gold did well in the prior two occasions. Let's go to 1937. This is when 1937 is after the bottom of the crash in 1933. They did their type of QE and quantitative easing, and at the top of the 1937 they turned it off. They did quantitative tightening and the market tanked. But in this particular case, stocks fell, but bonds did not fall. So you didn't make any money. Your stock portfolio was crushed, and bonds went sideways. So the correlation is started off very low, so non-performance, but came into it in the end. So the first 3 to 5, 6 months of your portfolio crashing in stocks, bonds did not show any reward. So it didn't really work well out at the end. In the crash of 1929, stocks fell dramatically, and the portfolio bonds did not fell a little bit, but not dramatically. But they did skyrocket at the end. So quite frankly, the 60-40 portfolio did not work well in the 1929 crisis. Didn't work well in the 1937 crisis. It did work well in the post-Nasdaq pop and the post-GFS pop. Didn't work well on Nixon. But what's quite surprisingly, if you had stocks and physical gold, you can't see it here, but actually gold on a percentage term has done well, pretty well, through all the moments I've spoken about. This is, I mean, the point here, even in the global financial crisis, we had a bit of a sell-off. There wasn't much going on there, and it recovered pretty quick. So you'd have to question the 60-40 portfolio of stocks to bonds. It might be better 60-20-20 as 60 stocks, 20 bonds, and 20 gold. Just looking at the data, folks. It's also good to note is it doesn't matter what the inflation is. Here in 1929 we had huge deflation, 1937 deflation. In the Nixon time it was quite a large growth of inflation, and it's been pretty moderate. So inflation is not really the question, it's just how the confidence at the time between bonds, stocks and gold. And Mr. Gunlatch and even Jim B. Yanko gave the references that the 60-40 portfolio would be at higher risk due to large money printing, because there'd be a lack of confidence in the bond market of the United States. Why would people pile in to bonds if the supply is going to be huge? Alternative investments would be looked for, and you'd have to think that gold and silver would have been an attractive investment, because eventually the bond market, through its massive supply from government money printing and huge deficits, just becomes unattractive in the next downturn. So if you're running a strict 60-40 portfolio of 40% bonds, 60% stocks, you have to consider, or do some research with your wealth manager to consider some of that 40% bonds might have to be split into hard metals, i.e. gold. Thanks for watching.